How is the IMF governed, and who makes its key decisions? Imagine a global team working behind the scenes to keep the world economy steady. That's what the International Monetary Fund does, but how is it actually run? Let's break down the way this international organization makes decisions and who holds the power. At the top of the IMF structure is the Board of Governors. Every member country has one governor and one alternate governor. Usually, these are the finance ministers or central bank leaders of each country. They meet only once a year, but they set the big rules and policies for the IMF. Most of the day-to-day decisions are handled by a smaller group called the Executive Board. The Executive Board is made up of 24 members. Some countries like the United States, China, Japan, Germany, France, the United Kingdom, Russia, and Saudi Arabia have their own dedicated executive director. Other countries are grouped together into constituencies, and each group is represented by an executive director. For example, the 46 countries in sub-Saharan Africa share 2 directors. This setup helps balance the influence of smaller and larger economies. Decisions in the IMF are based on a system called weighted voting. Each country's voting power depends on its quota, which is like a financial stake in the organization. Larger economies pay more into the IMF and have more say in decisions. Smaller countries pay less and have less influence, but every member still has a voice. Most routine decisions are made by consensus within the Executive Board. But for major changes, like modifying the IMF's rules or adjusting quotas, a supermajority is needed. Usually, at least 85% of the votes must agree. This means the biggest shareholders, especially the United States, can block certain decisions if they don't agree. The managing director is the person who runs the IMF day to day. They are appointed by the Executive Board and lead the staff. The managing director chairs the meetings of the Executive Board and makes sure decisions are implemented smoothly. Alongside the managing director, there are deputy managing directors and other senior staff who help run the organization. The International Monetary and Financial Committee, made up of finance ministers from member countries, gives strategic advice and guidance. They help shape the IMF's priorities and policies on a global scale. From a macroeconomic point of view, this governance setup influences how the IMF responds to crises. Because larger economies have more influence, their interests can shape the organization's actions. When a country faces a balance of payments crisis, the IMF offers financial help but often requires policy changes. These decisions are negotiated and approved by the Executive Board based on the voting system. Some critics say that this system gives too much power to big economies, which might overlook the needs of smaller or developing countries. Still, the IMF structure helps coordinate international efforts to keep the global economy stable. Its decision-making process balances the interests of many nations while aiming to prevent financial crises and promote economic growth worldwide.